We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
You got to have the why, and we know our why. So
you don't need to reinvent the wheel. Yep. Millions and millions of people have done this already. You can get help, you can get a roadmap, you can save a lot of time, money, and frustration. Welcome to the Value Add Podcast with K&K. Hey everybody, welcome back to another episode of the Value Add Podcast with K&K. We had the pleasure of interviewing Justin Brennan, who is a local, born and raised San Diegan, who is now syndicating. He is also a realtor with Sotheby's, and we had an amazing conversation about investing in real estate, the thing that we love the most.
Yeah, Justin, we kind of went through the process of talking about, I think some of the similarities we have is he works, he's an agent, makes his money, and then he takes that money and he's making that money work for him to buy apartments. And his goal is to one day, hopefully not sell real estate and just have apartments and keep growing it and growing it. I think his goal is to hit 1,000 units, then 5,000 units, but it was pretty interesting to talk to him, obviously, because we know the multifamily game, real estate game. He's done some deals here, but what was really interesting for Crystal and I is his approach to moving into other markets outside of California and how he enters the state and how he takes 6 months in the process he goes through, which, for us, that was cool to kind of hear the detail there.
Absolutely. I think for us, we are really big about investing in your own backyard. I think because there is so much research that goes into it. So there's that element of risk if you're not willing to do that research. And sort of for us, I think it's I think San Diego is a great place to invest. I don't feel the need to go anywhere else, but some people are looking for higher returns, more cash flow, and that sort of thing. So I think he's a great resource on how he has done it successfully, and also his philosophy about investing in real estate. I mean, his dad was a developer growing up, but he never invested in real estate. Everything he built, he sold. So that was a big takeaway for him, and it's really cool to hear his perspective.
So income was up and down like a lot of developers. It's like they always say, as you're a developer, you're rich, you're broke, you're rich, you're broke. And then a lot of developers we know that stay rich, if you want to say that, is because they actually kept the property, like Crystal was saying. So one thing I want to say before we jump into this, if you're in the real estate business or you're in the loan business or you're just in any business or you work, we're very passionate, just like Justin is, about saving money and putting it to work. So if you're a realtor specifically and you know Justin, you're going to listen to this, start saving some money, start investing, because you're probably not going to want to sell houses till you're 80. And if you do, that's okay. But at some point, you do want to have passive income.
I always say, start investing in the thing you sell. My gosh. Seems like it makes so much sense.
Well,
right?
how about they sell $5 million luxury homes?
Well, real estate.
Okay.
Let's just keep it real estate.
Okay. Yeah. Well, we're going to jump in right now with Justin. So here we go.
Justin, if you want to start just by telling us a little bit about your background and.
Yeah, born and raised here in San Diego.
Wow.
I know.
Not many of us.
We're like aliens these days. Kind of third generation son of a developer guy here in San Diego, and kind of grew up from the ground, digging ditches and laying pipe and doing all that stuff that my dad just wanted us to do so he could. It wasn't for any other purpose than to just learn how to dig a ditch, really, and learn the value of a dollar, which was good. It was very helpful and just hard work and determination. So, but yeah, grew up through that and kind of learned the building, construction, multifamily apartment business.
Okay.
Throughout San Diego, Southern California, and really, the financial crisis was a big change, I think, for a lot of people. It hit everybody, including our family. But from that and helping my dad consolidate his businesses at that time, because he was in development and construction, in Southern Riverside at that time.
Oh, gosh.
Boom.
Yeah.
Yeah.
So
there's a decline. There's another decline.
Well, no, I will never forget this. I'm not kidding you. So it was April 8th, 2008, around 9:30 in the morning, and he got a call from Royal Bank of Canada, which was our lender on a construction project. And we were under construction for 327 townhomes that were being graded right off the 215. And they called and they said, hey, Mr. Brennan, blah, blah, blah. Just want to let you know we're shutting down your construction loan. And my dad's like, what? And they're like,
I thought I heard you.
Yeah.
Say,
He's like, what? And they're like, yeah, we're shutting down your construction loan. And he's like, well, you guys can't do that. We have a loan. He's like, no, we're going to shut it down. If you want to do anything, just sue us. And that was basically the end of the conversation.
Wow.
And then, of course, the markets were,
They knew.
yeah, they're going
They already
100
knew.
miles an hour south. So, needless to say, that changed a lot of things. But I always say, greatness is born in bad moments, right?
sure.
So, yeah, it actually allowed then at that point, after consolidating businesses with them, I became an asset manager for a third-party asset management firm here in San Diego called Atlas REO.
Okay.
And they handled a lot of the major banking institutions' foreclosures at that time. So you're on the positive side of real estate or you're on the negative side of real estate, and that was a great learning experience to go in and kind of work with Fannie Mae, Freddie Mac, GMAC, Chase, B of A, Countrywide, blah, 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 right? It just kept going.
Maybe WAMU in there? Washington
Probably.
Mutual.
They got bought up, and it was
Yeah.
it was a nightmare. I mean, you guys were probably saw that, so.
The air down.
But yeah, I mean, and then kind of saw that translate into short sales from the REO business and jumped out in the broker business and been doing that ever since 2010.
Okay.
And then I mimicked that with the building construction apartment stuff that I've been doing over the last several years. So I'm kind of wearing two hats.
So you're selling real estate.
Mm-hmm.
Where do you sell? What do you sell?
Mostly coastal, San Diego, along La Jolla, Pacific Beach, Point Loma, a little bit into Del Mar and coastal San Diego. Primarily, it's kind of specialty. And but being born and raised in San Diego, I'm pretty comfortable with most markets.
Mm-hmm.
And then we buy, develop, own rehab apartments. Here in San Diego as well as outside of California, primarily right now outside of California.
Are you doing outside?
Yeah.
Where are you guys focusing?
We went into Missouri and Kansas City of all places, if you can believe that.
Wow.
I would have never thought that until I actually went to Kansas City and saw how much of an emerging market it is and what's happening with all the jobs, the growth, the university systems, redevelopment, all that stuff is there. It's booming. And then we're going into Texas and San Antonio. Maybe Austin, Fort Worth. We'll see how those markets are at. I mean, they're kind of getting a little bit too overpriced there, but we'll see. But San Antonio and then Tucson. And that's kind of the three markets we're focused outside of California at the moment.
Were you just primarily here in San Diego then when things were a little bit cheaper?
Yes. We bought most of our apartments in 2010, 11, 12, up to 14, and we stopped buying in 14.
Wow. Okay.
And then we just cash flow them all pretty nicely right now.
You've gotten a lot of appreciation. over
Yeah,
the
a
last
lot
few
of
years.
appreciation.
Just you and your family? Or you guys
Me and my business partner. So Christopher Poley, and then myself. We started the company out of grad school back in 2007, 8, and didn't really do anything for the first couple of years of it until 2010, and then started buying then.
So like syndicating?
Yeah,
Okay.
yeah.
What kind of deals did you have?
We started just with our own money, and then it
That runs out kind of quick.
Yeah, that runs out.
Yeah.
They're like, oh, well, maybe we need to bring in some investors. So
Yeah.
we started pooling investor money to buy some more deals. And then we do new construction as well. So we've done a couple ground-up deals in Point Loma.
Wow.
And then we're entitling about a 19 or 20-unit deal in East County, San Diego right now.
Is it all multifamily, not for sale?
Yeah, all for rent stuff.
Cool.
All for rent for right now. The condo market isn't quite there.
Did you are you in that space because your dad and what you learned, or just more on your own?
Yeah, you know what? It was a great learning experience because my dad he built apartments, but he never held them. And
Are you like, Dad?
well, now, because I mean, God bless him for helping put me through school, which taught me a lot of great things on the financial side of things, because he would also make a ton of money, but then would lose a ton of money, and his net worth and income would literally mimic the real estate cycles for the last 40 years. It's great, but
life's
talk
good,
about
we're going on trips. Life's bad, we're not going here.
But then you're sitting there going like, how do you sleep at night? When you get, because it's very stressful. So I sat there going, well, how do you counter this? And the one common denominator I've seen in a lot of extremely wealthy people that I've paid attention to over time is the liquidity of residual rental income properties. And that can come in apartments, retail,
Anything.
Absolutely.
just rental income type assets.
Yeah.
So
That was my next question. Why multifamily?
it's what I know best.
Okay.
I mean, it's what I went to school for. I mean, I know it. I mean, I literally, I kid you not, like I wake up in the morning, I'm like, cash on cash returns, NOI, like operating expenses, that's like literally wake up doing it. So I know it inside now. So that's why I'm comfortable with it.
Are you guys self-managing or?
Locally, we are. We have our
Wow.
own property management company locally, but outside, no. We have professional companies
How many
running
units you have locally?
it. 20.
Okay.
It's currently, well, it's actually technically going to be 40, but that's local because we sold some as well.
Yeah.
So we had them and then we sold them recently, so we could cashed out a little bit to take it outside of California.
Yep.
And then we started buying. We just we're about 2 or 3 different properties last year, about 100 units. And then now we're in a point where we're going to probably start getting into the 80 to 100 unit type acquisitions, because we've kind of graduated in from the 2 to 4 unit space into the 5 to 10 unit space into the 30 unit space. And then now we're getting into, okay, we're ready. We kind of have the operations down pretty well. We can get into that next stage.
So how do you guys do your market research too to determine what new markets you're going to go into?
Online, a lot of it, through, you're looking at job growth in certain markets. You're looking at median income in certain markets. You're looking at development in those markets in terms of what does the general plan for the city or the county have planned forward. Light rail systems, mass transit, university systems. We love university
Amazon
systems.
join.
Yeah, Amazon, right?
No,
But that's why we liked Kansas City, right? There's literally 41 between, public municipal colleges, large university systems surrounding that metropolitan Kansas City area.
Wow.
There's 9 Fortune 500 companies. There's a massive redevelopment sector going on. If you actually went there, you'd be like, it reminds you of downtown San Diego in 2004 and 5.
Okay.
Like just kind of getting started. You're
And
seeing
I'm sure
things
the
going
price per
up.
door is a lot cheaper.
Oh, because we just bought one last year that's a C property. We're going to turn into a B at $56,000 a door.
Wow.
We bought another one at $83,000 a door. And we're going to turn them into $110,000, $120,000, $1,000 door properties within the next few years. But that's what is available there versus here in San Diego. It's like, you're buying at a 3 cap. Now it seems, or 4 cap.
What kind of tenants are you? Are you regentrifying to tenant base and things like that?
In some, yes, but you'd be surprised. There's a good tenant base. The median income is good. It definitely is allowing the growth of rents at that 2 to 3% level for sure. And because of the university systems, the job growth, all that's there, it's allowing kind of wages to creep up and then rents to kind of follow it. Yeah.
What are you kind of doing to add value to the properties? What's your kind of focus on?
Yeah, usually you're going in. Like one of the buildings we bought it was a kind of a C plus B minus already.
Okay.
And we're just doing washer dryers in the units, rehabbing the kitchens and bathrooms, and that's it. Everything else is pretty nicely remodeled. And
Washer
that allows
dryers, that's a lot.
It does. It's a huge ticket. So we'll get a couple $100 a month on that, just that alone. And then
I think people stay longer. Like we had Alan Nevin on the podcast too, and he was talking about that. And that
he was my
one of the
professor.
things I
believe it.
love.
Oh my gosh.
Yeah.
It's so funny.
He is a professor,
Yeah.
let alone, yeah.
He
for
is,
sure.
but he was right. He had a really good point about putting laundry in the units too. Like your tenants are going to stay longer. No, everybody ideally wants laundry in their unit, but it's one of the things I think a lot of rehabbers don't do.
Right.
So that's a smart.
We do the stackables
Yeah.
and get it in there, so they like that, and then we can then find a way to do a reimbursable on the utilities. Sometimes $25 or something like that on a monthly basis.
I think when you have laundry, for sure, you have to bill back because they're using it.
Yeah, they're sticking and just throwing water in that thing. So
Yeah, it's amazing what people pay. Like Alan was like too, especially he's like San Diego. He's like, take North Park. If you give them a garage, you give them laundry, they're never leaving. Like it's like parking.
Yeah,
it's true. But the value of that in rent is unbelievable.
it is
Because nobody, if you have a garage, storage, or parking,
And you can't really quantify it, but vacancy loss. Like if you can reduce your vacancy loss, that's huge too. Even though we're at sub 3% vacancy in San Diego, you still want to minimize the time that it costs you to turn over and rent.
Because you do that, and depending on how many units you have in your little plex, if it's a 4-plex or a 5+ unit property. Yeah, it's that turnover, like you said, but then it's the time lost, and then it could be a 60-day turnaround from tenant moving out, fixing it up, getting it back on the market. Okay, now you find a tenant. They need a 30-day notice before then they can move in. So you may have a 60-day loss of rent.
Yep.
So.
Yeah, I don't think people if you haven't gone through it, they understand that. It's like, it's like this.
So we'll give concessions and rent abatements or not rent abatements, but like concessions and stuff to get through certain times of year, or reduce it if we're doing some work in the property, so that way they'll stay there and not move out.
Yeah,
because
smart.
we know that turnover cost, is much heavier for us.
It's better to kind of be ahead of it too than wait till somebody's so fed up that they're ready to
Peace
go.
out.
Yeah.
Oh, for sure, right? Are they? So in other states, how is it? Are you renting? Is it demand here is crazy, but what's the demand like?
Well, sunny San Diego, we have this beautiful thing called weather, so it doesn't really hinder the cycles as much. But yeah, Kansas City, give you a perfect example. it gets cold there.
Yeah.
So it's Midwest, and so I didn't understand this fully until this year. It was our first winter, I mean, but, come November, I mean, the rental cycle, I wouldn't say shuts down, but it gets really hard to rent
That's
property.
when you're giving concessions, right?
Right. And so we had...
Who wants to move, right? It's like
we had leases coming due where those people were like, okay, what do we need to do to get us through the winter? We're not raising rents on these people right now. And so we did that. We made it actually a little bit of a concession, got us through, and now we're coming into March, and that's fine. Those are going to turn over. We're going to rehab them, and that's okay. But, yeah, we would have lost because we had one unit we rehabbed in November. We just rented it.
wow.
So just because of the winter.
Are you structuring your leases now not to?
Yes.
Yeah.
So the property management company, because I went and staggered things out, and I said, okay, these ones are here. I said, I want these things coming due in the spring into the fall, and that's it. So I don't care if we need to do 9-month leases or do, 18-month lease or whatever we got to do.
We even do that in San Diego, just because the holidays too.
Yeah.
I mean, you don't really. I feel like right around November, people are not wanting to move during Thanksgiving and Christmas.
That's true.
And January's slow. February can be slow too. It's like March kind of starts hitting it again.
Mm-hmm.
So whether or not,
It's still there.
I grew up in
there.
Oklahoma, so I'm aware of the weather. I was very close to the Kansas border.
Yeah, no, and I was looking at a deal that another buddy of mine out of Texas, they're in a much different stage with the syndication market, but they're buying an 850 unit complex in Oklahoma.
Yep.
And I'm like, that is a massive deal. For about, I think all in on it, it's about $50 million, and that's for the rehab plus the acquisition of about, I think they're buying it for $50,000 a door, which is great. But I've learned a lot from him over the last year or so, just on basic rules of thumbs. When he can look at a deal and say we'll dive in further or we won't. Just in terms of where the rents are at versus the acquisition price per unit. So
I was gonna say too. I mean, when you're looking at other markets, we're always big advocates of staying in your own backyard, and part of it's just because finding good management, finding the deals.
Yep.
So how did you guys start building the relationships to even find the deals?
Yeah, great question. So that, it's funny because I was the same way. I was very scared of leaping out of what we know best, which is San Diego. But when you can't find opportunities, what do you do? Mm-hmm. And I knew we had to scale and grow. Mm-hmm. So I said, okay. So the first thing that started was September 2018. I went out to a syndication conference in Boston. And that was amazing. 3,000 to 4,000 people were there. Brokers from all around the country, investors from all around the country, a lot of people, and met an enormous amount of people. Everybody from the markets I was really looking at were Georgia, Florida, kind of the southern hemisphere a little bit, and then some Midwest. But ran into a great broker from Kansas City, one from the Texas areas, one from Georgia, and one from Florida. So we've connected, sharing ideas, things that are going on. So that started the process of how they did it, and then just learning, right? Success leaves clues. So I said, great. Well, what did you guys do to get going outside of your states? And so what they did is they go in about 6 months in advance of any market they're going to enter. They set up all the infrastructure, right? Property management firms, construction crews, brokers, people, all that ground infrastructure, logistics, all of that. So that way, once deals start coming across the table and they're underwriting them, they have all the systems and logistics, operations, legal, finance, everything in place to start pulling the trigger and feel confident that they're not going to fall over their face once they go into that market. So we did the same thing. Kansas City went out there 6 months in advance, met with the brokers, property management firms, interviewed construction crews, PM companies, finance, all the local commercial banks. Blah, 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 and got everything set up to where when those first deals start coming across the table, we could strike. And I knew that we had all the logistics wrapped up.
It's really smart.
Yeah.
Yeah, I think that's the number one question because we've had a lot of clients that do try to go out of state on their own.
Yep.
And the kind of general comment is when you're from California, you almost have sucker written across your forehead. They're like, we got a hot one.
Totally. They're like, oh, this guy's going to overpay.
Yeah.
So, but you just do your due diligence. You have good people on the ground that you trust. The market is the market, and you just kind of match it up. It's all about, you see what they send you across on the pro formas. That's great. You do your initial underwriting. Mm-hmm. But then you got to go kick the dirt. You literally knock on doors, walk the communities. I go sit at every community about 6, 7 at night. I watch everybody come home. I want to see how the community kind of interacts, make sure there's not too many bars on the windows, things like that.
Oh, for sure. Yeah.
And you do that during the week and right before the weekend, because then you're going to get a good feel for how that neighborhood interacts. And that's how we've always done that. Just to
So are you still doing a lot of travel for deals now? Or?
Not as much. Well, I will be coming up. But yeah, usually once a quarter I'm out into the markets we're looking into. So, and then once we go in there, I'm usually there once a month as we're going. And then once it gets stabilized and settled, then it's usually once a quarter. Yeah.
So one of the things I think we've usually talked about too is if we were ever going to go outside of San Diego, that it would have to be a pretty sizable deal to make sense for the travel.
Yep.
Was that sort of your philosophy as well?
Yeah, but also learning too. I mean, some people say, "Oh, no, go big, right? Go big." And yeah, true, but that's also you can make bigger mistakes. And if you're going to make mistakes, it's better to kind of figure those out on smaller deals first. When I say smaller, I mean 30 to 50 unit properties. So that's what the next stage for us was, and we did that. And we ran into some problems and issues that I would have never thought of. And thankfully, it wasn't on a $50 million deal.
Right.
It was on a $3 million deal.
Yep.
Yeah.
So we've ironed that out. Those mistakes won't happen again. And then so that allows us to kind of figure out the logistics of how a 30 and 50 unit building work, which are somewhat similar to a 100 and 200 unit. There's just more zeros behind it. Right. And so we can just copy, paste, repeat, and then just apply it to that building.
Well, there's sort of a skill too. I mean, not just owning in your own backyard, but like you said, just going into different markets. Like that's a whole other skill, is learning to navigate the issues that come up from just being out of market. Right.
Yeah. And just the nuances of what would break down in Kansas City is not going to break down in San Diego.
Yeah.
Right. And it's the weather element that causes that.
That was some of the biggest learning lessons for you.
Yeah.
guys?
Yeah, I mean, just.
What do you mean we have to get a snow plow? Snow. We have to.
You mean I have snow removal on my operating expenses?
Yeah, exactly.
So
We've seen that.
It's those things.
It's not cheap either.
It's not cheap.
Yeah.
And you just learn things that are market specific, and that's okay. But you know what to look for if you go into other similar, environments.
That's kind of like what I thought you were going to say is weather, because I don't. Like, people are like, we're here like snow plow, and then people don't realize. I remember looking at one lady's financials, like $20,000 for snowplow. She goes, yeah, like 20,000.
Well, like things like
That's
Texas,
crazy.
I'm learning, soil. Right? There's certain issues in certain areas of Texas for soil that you got to make sure you're doing certain reports when you're doing your due diligence to buy properties because of the soil type that's in Texas. So it's just little things like that you would never know. But that's why having good brokers and good people on the ground in advance and having all that infrastructure set up, so that way you don't make real big mistakes.
They
On
can be
big,
there to help
big
educate,
zeros.
yeah.
And then your investors are like, do you know what you're doing?
Yeah.
And that's not a good conversation to have.
No.
So,
Yeah, it's funny. A lot of people that I know to go in Texas that are from here selling, they have to like partner up with a syndicator in Texas or whatever just to get in to get deals accepted, or even because they're like, I don't even know anything, because it is scary going to another market, especially if you have to trade and you're buying a big deal like you said.
yeah.
You
And,
know what I mean?
I'm sure you guys all know who Grant Cardone is.
Yeah.
He has his own philosophy and methods and stuff. But one thing you can pick away from him is his process for how he looks at deals, acquires deals, and how he goes into the markets. And he'll go in and get the top one or two brokers. He says, I'm going to work with the best. And he'll go in, and because of those relationships, he can get deals done. Where if you maybe had a side broker over here, because the commercial space is different than, say, residential, they can get things accepted where otherwise maybe people would be like, oh, we're going with these guys.
And what's your kind of goal with this? I mean, I know obviously you're busy because you're selling real estate, right? That takes
Right.
up a lot of time.
Yep. Goal's 1,000 units first. And then once we hit the 1,000, 5,000. And then once we get to a point where you have enough residual income, I'm not looking to try and have 10,000 or 20,000 doors, but if 1 to 5,000 doors, and if you're owning 20, 30, 40% of those because you're a syndicate, the rest is owned by the investor group. I'm okay with that.
Life's pretty good.
Yeah, I'm okay with that.
Have you found too, I mean, that the bigger you get, the easier it is to grow?
Yes. So absolutely. I mean, I was like, man, to buy a 2 to 4 unit property, what a pain in the,
Yeah.
Are we allowed to say ass on the
Yeah,
show?
of course.
All right. What a pain in the ass.
Yeah.
But you go in and you get a 30 unit, they're like, here's your money.
Yeah.
I'm like, what?
And you get 100, and like, come here, here's your money that's even cheaper. You're like, what?
I'm like, are you guys morons? No, I'm just kidding. But yeah, it does get, as long as you have a track record and it can be backed up, and keep in mind they're underwriting the property more so than the financials of the person signing on the loans. And most of it's non-recourse for the most part. Unless you're doing some rehab construction type stuff that'll attach recourse to it. But Yeah, the money is cheaper. It's a little easier. You get bigger, and it just seems to flow better because there's economies of scale to it as well. So 100% on that. That was a surprise.
Yeah. Well, I always tell people too, because he does residential financing. I'm like, you're not gonna have to go through any of that. Like you go through a fraction.
I do loans. I've been doing it for 15 years. You do sell risk. We know it.
Yep.
It's like, and so I work with a lot of real estate investors that, they went and got a $10 million loan. They come over here to get a residential loan. They all like, what? I just got a $10 million loan. What the hell's wrong with people? I'm like, business loan? Like,
yeah, well,
we've got all this yellow tape on this loan. It's just,
and keep in mind when they're doing the residential side, they realize that asset may not produce an income.
Yeah.
So it's looked at much differently than a business asset that is producing an income that they can leverage.
Yeah.
And that's how they get repaid. Because if you're not going to pay me, the property's going to pay me.
Exactly, right?
So I don't really care about you as much. I care about the property, because if you don't perform, no problem. Property's ours. We'll take it.
Literally, the biggest thing I think people don't understand about residential, you said, is the biggest holdup. The biggest thing is it's why we went through the whole collapse, and what really the government cares about is like, do you have the ability to repay this payment every month? And it's like you said, if there's no cash flow, you don't have a job, you don't have this. How am I supposed to
leverage it?
Sell the loan?
Where's my leverage?
How's Fannie Mae? But if you have over here, I got this big apartment building. They're like, if you die, they're still gonna pay.
People are still renting.
Exactly.
And they're still gonna pay it. And that was one of the greatest learning experiences for me, is understanding that I was saying out there is people, they live in one of two places. Well, in most cases, right? They rent or they own. Mm-hmm. Right? You rent or you own, and more people rent than own. And so if you're not going to go buy and sell and flip houses, that's one method, then go own properties that produce a cash flow. And then you're allowed to ride through the recessions a little easier than, the buy and sell, which my dad did. And so I got to watch it, like, hands down, like, because he did single family subdivisions, he did multifamily subdivisions, he did condo subdivisions, but they were always build, sell, which was great, big pops, but you get caught in the market, party's over. And you see that, and I learn, and I'm like, well, I don't like that.
And one deal can kind of take you down too. So that's the
right.
hard.
If you're over leveraged, like the financial crisis was in 2008 and 9. I mean, it was so violent and so fast that, just about every developer I knew was getting wiped out.
Mm-hmm. Yeah, and that's what people don't realize, I think, and we always talk about it, is people are like, oh, should I refinance now? Should I get cash? And I said, screw the rate, screw this. They're lending money.
Yeah.
You forget that if things are great, but if they go bad, people might just be like, yeah, we're just not going to lend money right now. And you understand, like, they might call you and say, cool, you can sue me if you want. We're not going to give you any more money.
Right.
You want to fight us? Go ahead. If you have that much money.
When they realize how violent things are going, they're like, you don't have the capital to probably sue us, so let's have some fun.
Yeah, and I think people forget, like, that's why I tell people, if you can lock in and do it, do it. Like, what are you waiting for? Question for you is, it's funny because, real estate agent, you're doing this because you want the cash flow. Mm-hmm. We're in an industry that's like up and down.
Right.
So you sit here, we came out of 2008, real estate agents crash.
Yep.
They went into short sales, REOs, whatever.
Yeah.
Now they're all doing good, making money. And so, because you're in there, are you being like an influence on people to see, like, hey, instead of just spending all your money, which they're always good at, or are you? It's funny.
Yeah.
They've been through it, but like, I don't see people really learning. Like, I think even you're like, you watched your dad, mm-hmm. which is amazing, and you're like, I like how you made money, but the problem is like Robert Kiyosaki said, is you made money, you didn't keep it, but better at the money you keep is not making money.
Right. And you guys know the cash flow quadrants. You talk about Robert Kiyosaki. Yeah. So that, I wish I would have learned. I can't believe I didn't learn that until about 2 years ago. I wish I would have learned it in like the financial crisis, because I would feel like I would have been much further along understanding, the E, the S, the B, and the I quadrants, and how it all interacts, and how ultimately most of us are sitting in the E and I quadrants, and we need to get to the B and the I. That's the only way to financial freedom, right? Is B and the I, and the sooner you do it in life, the sooner you get to enjoy free time. So that's ultimately kind of kicked me in the butt once I was like, well, we need to hurry up, because I'm 40. I don't want to wait till I'm 65 or 70 to retire, right? I want that like in the next 10 years.
Right.
The only way that's going to happen is to accelerate it and get into the B and the I as fast as we can to generate the cash flow, So that way I can say bye-bye to the S quadrant, which is what I am as a realtor, and hello to the B and the I quadrant, if that makes sense.
Oh, no, it's just...
And you pay the most taxes, too, on those quadrants. Like, that's the other thing for us to kind of talk about is how to move over to that, too, is, like, the taxes that you pay, too. Because you get rewarded for giving people homes or creating jobs. Like, those are the things you get rewarded for. You don't get rewarded for being on that
Well, unless you have an
side.
S corp. I mean, so I said, hey, I'm not going to be a Schedule C or whatever they call it. Right. I went ahead and set up an S corp to run all the commissions through. So that way I get to run it just like a business would and have the benefits of, write-offs that would be part of business expenses. So
that's the one thing they teach new real estate agents, though, too. And even for me, when I first got started doing financing, it's like the people who are training you, they tell you, like, yeah, go buy the nice car, go buy the house, because they need to make sure you need that commission every month, all the time.
You got to feed the hamster wheel.
Yeah.
And look, it's the residential sales business is an incredible business. It really is. It's an opportunity for people to make a great income, great career, but you have to have an exit strategy.
Yes.
And
or
I think
you see people that are still working, and you're like, why? It's because they have this lifestyle, and they're like, I'm not going to bring it down, and they just keep it going.
Well, keep in mind, there are people that just love that for sure. Kind of like they're just sales, like they love it, like it's
addictive,
right? And so for them, they'll do it till they're dead because that's what they love, and that's awesome. But for me, the residential sales business is not something I absolutely wake up first thing in the morning and I'm like, yay! Like, I get to go like drive buyers and sellers around. So for me, I see it as a catalyst to get into the apartment industry and do what we're doing, and then ultimately exit the sales game as soon as humanly possible.
That's the same as us. Yeah, we're pretty much in the same boat, because I want to be able to do whatever I want to do.
Right.
Like you said, I want to wake up and go, like, if I feel like selling some homes,
great,
I'll sell some homes.
Great.
But if I don't feel like it,
we're not.
I want to have the choice not to.
That's right.
Yeah.
And that's those choices, and the money gives you those choices.
Yes.
See, money says, does money buy happiness? No, but it buys choices.
Yeah.
And the choices you make can buy happiness, right? Because you can travel, right? You can spend time with your kids. You can have memories and moments, experiences. That's happiness. Or you can go buy a car and a dress and go to Vegas and party in nightclubs. And that is like short term, but it doesn't bring the ultimate happiness.
Right. Yeah, and I think people forget that's the big thing, where a lot of this content we do is about investing, buying real estate. Like you just said, it's like getting into the other quadrant over here.
It's the B and the I.
And people don't even, until you really understand what this means from like a tax standpoint and what you can do, if you don't understand it, then it's kind of like you're not going to get addicted to it, because, and we actually use Wealthability, Tom Wheelwright, under for CPA. We switched over.
Yeah.
Which he's really smart. That's where obviously Robert got it from, was the whole thing.
Interesting.
Yeah, Tom Wheelwright wrote him out and said, this is how it is. Robert's like, oh, well, you need to be over here, and this is why.
Yeah, once I literally learned that whole quadrant thing 2 years ago, and I'm like, wait, it was an epiphany. I was like, so that's how it works? And I'm sitting here going, I should have known that maybe 8 years ago. It would have been great if I would have seen this. It would have accelerated things, but it is what it is.
Yeah, and like you were saying is I think, things are good when they go bad. I think a lot of people that bought all this crap that they really didn't need, they're going to be like, when it's slow and they're struggling and they got to get through the 2 years or whatever it is, that's where you're like, yeah, if you had some residual income to get you through, like look how many agents went into property management last cycle. Like, I got to make money. And now I'm a property manager all of a sudden. All of a sudden you're like, wait a minute, I thought you were selling real estate. Well, now I'm managing these 50 properties for these people I know, because I got to pay bills.
Yep.
And so I just think when people understand that model, but you got to go there. You got to be willing to try it.
And I mean, if you're in like the position I'm in, where I'm selling real estate to pay the bills, but then as Gary Vee would call it, you got a side hustle.
Yeah. Yep.
Right, and that's where the apartment game comes in. So my 9 to 5 is selling real estate. My 6 to 10 p.m. at night is apartments.
Yep.
Right.
And that's just the way it has to be until this income overtakes this income. Right, and we're not too far away. But it's a transition. It takes time, and you better be ready to hustle.
So is your goal to always syndicate, or what's?
Yes. I mean, when you say syndicate, what's interesting, what I learned is that syndicate, anytime you raise money from anybody, legally it's a syndication. Right. It's just a question of how big it is.
Yes.
But yes, I do see myself getting more full-time into the syndication business. But we like to own our investments, not just I mean, it drives me crazy, some of the syndicators that don't put any money into the deals. They get paid acquisition fees and all these fees, and they have no skin in the game. And I'm like, how did you convince somebody to give you their money to go buy this apartment building, and you guys have no skin in the game?
That's a hamster wheel too, though. I mean, like, they need those acquisition fees, and they have to find deals, and like in a market, like if you're still in San Diego and you're a syndicator trying to find deals, I've looked at that like, how are you?
Not going to happen. Yeah, you have to go outside of California, and then you need to work on the ownership side, so you have that distribution, right, the cash flow, because that's how you build that, and keep the leverage low and keep the expenses low, and just kind of.
So are you a long-term holder? Is that sort of your philosophy?
Yes.
So you guys, how are you finding investors?
Up till now, it's been friends, family, network, people close to us.
Awesome.
And kind of building that, right? And as investors see the results, obviously they tell other investors. And most of our investors are people that would otherwise have their money sitting in a mutual fund, right? Very conservative type investment vehicle. They're like, great, I'm earning 8% over here. Why don't I go earn, 8 to 10 to 15% over here in a real estate asset that produces cash flow and it's safe in a way, right?
And you get a K1 that shows 0 when you made, 30,000.
Because we do cost segregation. Are you familiar with that?
Yeah.
Okay, so we do cost segregation on all our buildings, so that way we get to accelerate the depreciation for our investors. So they literally are making money but getting like losses, if that makes sense.
Yeah,
So.
you know about the bonus depreciation, right? The 100% bonus. So
No.
Well, that's what Trump did, and a lot of people don't understand. So if
Are you talking about the opportunity zone?
No.
Oh.
So if you bought a building, so let's say we have cash, we go buy a building.
Yeah.
You do the cost seg on it, and they come back, and let's say, hey, we can do this over that. But if you're an active real estate investor, if that's what you're classifying in your tax returns, you can wipe it that first year.
Really?
Oh, yeah.
Ooh, that's good.
So I don't know how that works
And
for
that
syndicate.
applies to some W-2 income, like up to $250,000. I want to
so-
say,
Yeah.
and
So-
it
Interesting.
applies to
So
it's not just real estate.
Tom Wheels,
earnings.
right? It's like, let me give you an example, right? He's like, you've got a doctor. I'm making $1 million, W-2, whatever over here a year, out of his corp, W-2, 500,000 gets the K1. And he's got his wife over here that's Mrs. I'm buying multifamily because
Right.
this is common. So they go buy this $4 million building, and then he gets a seg, and all of a sudden he's like, hey, we can wipe, it's $1 million you're going to depreciate over
Right.
this. So they call Tom, go, cool, we can do the 100%. So he just wipes 500,000. So his income went 0, pay no tax. So he goes, then you can go buy again. So a lot of these big guys, nobody's really paying attention. A lot of the big guys that are buying real estate right now,
Right.
their cash flow, they're like, cool, so I can just buy, stack that bonus. And if I don't use it, just kick it next year, right? Loss carry forward. And think about how much buying power that is. So I just, instead of the taxes keep going and going and going.
That's interesting.
This is in law until
2017.
2026, I think.
Oh, yeah.
Oh.
It started
Yeah.
in 2017, and now it's in,
Yeah.
That was a Trump
cool.
thing.
So
Yeah.
your way, we see that, and that's what the other thing is. The other thing, which we always tell people, which or maybe don't know, is obviously you probably do, but you buy the building or you go exchange in, put a lot down, rehab it, and you're like, hey, we can just, we got a lot of equity, rates are good, let's just do a cash out refi, pay back some investors. And I tell people that's tax-free money.
Yep.
And people are like, what do you mean? I'm like, yes, you could exchange into the building.
Yep.
Maybe you wait a year to do some rehab, call Crystal, hey, Crystal, I put $5 million, it's worth, $1 million more. Cool. What can I get? Give me max leverage on it, do an IO payment. I'm going to go buy another building, and that's tax-free. People go, what? Again, that's how you build wealth, another way.
That's
you
right.
get it, yeah.
Yeah.
So there's all
100%.
these
And we
things.
will refinance these properties that we're in now because we're in a 2 or 3 year interest only to do the rehab. So we'll get through that, rehab them all, raise the rents, restabilize. We'll have obviously added value at that point. We try and keep our leverage, if we can, give our investors back money, but keep our leverage at 75% or less.
That's good.
On purpose. And it's not so much because what ends up happening is if people start taking 80% or more, that's fine when it's good.
Exactly.
But the minute the market starts to change and vacancies rise, and now you go from, where's your break even on that building? And I try and keep that break even at 70, 75% to where we can take a 25, 30% vacancy rate. Because what investors care about most that I've learned is when shit hits the fan, there are 2 things they care about most. 1, don't lose my principal.
Yes.
And number 2, please find a way to just protect my money until we can ride to the upside again. Like in worst case scenario, Like, if you can't give me a profit or a distribution, then at least protect my principal. Don't lose my money. And make sure that you're protecting the building or the assets so we can come out of this thing if we just have to ride through the rough water right now.
Yeah, and I think for us sitting in San Diego, people are like 20-30%, that's ridiculous. But I'm like, but if you go back to last recession, that wasn't ridiculous because it happened. You know, it happened in Arizona. I know it happened for.
Because what happens in those, what happened in the last time, and what happens, what people don't understand, because this very wealthy guy that owns about 4,000 doors, he said, Justin, what does vacancy mean to you? And I said, well, when people move out, you have a vacant unit, it's vacant. He says, no.
It's not paying.
He says, what you're not calculating is what happens when people double up and triple up when times go in the tank. Families double and triple up.
Yep.
So then when you thought you'd had 3 units that were going to be occupied, now it moves into 1. And maybe they go to a single family home versus an apartment unit.
Saw a lot of that. Yeah.
Right? So now you have consolidation in larger families into 3 and 4 bedroom homes versus 1 and 2 bedroom apartment units. So that's a totally different level of vacancy that people don't calculate when the market tanks. They just think you get higher, vacancy rates, but it's actually people consolidating into other property types.
I remember
You're going
doing
somewhere, right?
Yeah,
Yeah,
that's right.
I remember doing loans for clients in 2009 and 10, and we would be doing like the appraisal, right? And you'd be walking in, and you'd see families in the living room and the dining room, beds everywhere. Yep.
It sucked, man. We all watched that.
Yep. So
nuts.
it's a real thing. It happens.
And what do you guys think about what's going on now between the coronavirus and the markets? And I mean, we're down about 4,100 points right now from its peak.
I mean, rates are crazy low.
Yeah.
Which is good for our industry. I mean, look, I see people right now. I always tell people the rich keep getting richer for reasons. The money they can borrow right now is insane.
Cheap. Yeah.
So they're like, cool, go refi, cash out, sit it on the sideline, wait.
Yeah.
Why not? I think I see people cashing out right now, maybe putting money back in their properties or looking for, if you can go get a lock-in rate at 3%.
You're silly. Yeah,
like
not to.
Like, cool, here, Justin, go.
It's borderline free money.
Go make me 7%. It's kind of not a.
Yep.
So, I mean, the virus is. It was funny. I keep saying this story to everybody. Davos is the thing they have in Switzerland. You know that. So there's all these CEOs, and I can't remember his name. They were interviewed, and they all say, "Oh, this is gonna happen." One guy comes on and he goes, "What's your biggest concern?" He's like, "This virus." And this is before the virus was
interesting.
Now. And they're like, "That's your concern?" He goes, "Oh, 100% that's my concern. It's going to be a major problem." She goes, "You think that's going to be the biggest concern of this year?" 100%. Because we're being lied to right now how bad it is. Sure enough, I tell people a month and a half later, I'm sure this guy, I don't know if he owns a fund, has shorted this market. But he literally, everybody else was maybe a snippet out of a 20-minute interview. This guy would not leave it alone.
Interesting.
So
he did say this like a month ago
Wow.
or something. He was like, watch, I think it's going to be a
Record
problem
it
for
and get
rates.
this out. That's
Yeah,
crazy.
no, I
Mitch
came
in
in
our
here.
office
He
was
didn't
like,
believe it.
no.
It's not going to be that bad. So
Interesting.
I just think, look, we've had a good run. And I was actually something, because you're in real estate, you'll appreciate this. So I watched Aladdin told me to watch this one, but I watched Sam Zell was interviewed. He was actually on Tim Ferriss, but Tim Ferriss brought somebody else in to interview Sam Zell. You know who he is, right? So Sam Zell said, everybody keeps saying, "Sam, where are we in the inning? What inning?" And he goes, "Look, a couple things. Number one is everybody keeps thinking, what inning we're in real estate?" He goes, the stock market started to make a change in 2009. It started correcting.
Yeah, so we've been on a 10-year run for that.
Yeah. He says, but real estate,
February 2012.
Quit telling me 10 years, because the real estate market didn't really get good until 13 and 14 right there. That's where he's like data driven. Like
when you got out of San Diego.
No, when you actually look at the data on the real estate, it was February 2012 was the bottom. But you're right. It was 13, 14s. We had the crazy runs, but it started in February 2012. So we're literally 8 years like now.
Exactly. So
we're
he
10
says,
years in stock.
So he says when things get better, to him it's 13, 14. So we're out. But he said another thing he mentioned is he was talking about rates. He said everybody keeps saying rates are going to go up. He goes, look, we've been in a low rate environment for about 25 years, relatively low.
Yeah.
And he says everybody refinance. When I say everything, that's corporate, that's government, that's everybody. So if everybody keeps thinking rates are going to go sky high, he goes, it's never going to happen. We live in this rate environment.
Sure.
Nobody's going to allow it, because we already know
when
we go, look, if we go up a point in real estate, it's like the whole thing just.
Well, and it's not only that, but it's the debt that the Treasury's having to pay on all this money they're printing.
It's $1 trillion.
Right.
Just to.
I mean, I was saying it the other day, it costs about $10 billion a day to run the United States, right? We make 6, we print 4. And they print 4 and they just like pay the interest, and then they print 4 more, and then they pay the interest, and they keep printing 4 more. And that's why you see the debt thing going through the roof. And the ship's too far out to sea. They're not going to change it. They know it's the great experiment. It is what it is. At some point, the party's going to end. The question is how and how drastic and what's it going to look like. Is it a currency crisis? Is it something else? But I think it is going to be something based around currency. Just don't know specifically what it's going to look like.
Yeah, so Robert Kiyosaki is really like diving in. He's big on like watch corporate debt, corporate all that. That's where he says the problem. A lot of people were borrowing debt to go buy back stock.
Right.
To raise that. That's a problem. That is a problem.
Gotcha.
That is a problem. Because you're creating, and then basically next thing you know, Mr. CEO is like, hey, I'm going to sell some shares.
Sure.
Yeah, that's weird. You just, and then he said the other big thing is he just wrote a book, came out, is the pension crisis.
Yeah.
So he thinks the pension crisis is going to be what's going to cause the next, meltdown. And that's where he goes into is, he's like, you're being lied to. So his thing is all the pensions, like you said, is we spend $10 billion a day, we make 6. Well, the pensions, he says most of them have 20-30% on the dollar, which they owe. So if we owe $1 trillion, we have 200-300 billion in the bank.
Boy.
And so he said, he gives an example. I mean, you're kind of listening to this. Like there's this UPS driver in New York, which was getting $5,000 a month, and they called and said, basically sent him a letter saying there's no more money. Now he's down to $1,000 a month, and he's writing this book, and he's doing this part series on his podcast, and he has this guy that worked at the SEC that was used to research and parties. Now he's making his money by. What are you turning him into the IRS and getting their reward? He just spent $75 million, but he said it's such a joke. But what's the bad thing is there's a pension and there's this manager in Wall Street, the whining and dining. It's such
they're
a
like
mess.
dipping into the pensions too.
So Robert says, I always go back. I said Social Security was created in 1936-7, and I'm like you start looking like I want to go back and research why this stuff was created. So Social Security was created because you and I went through the recession and we're old, we can't work. So I'm only getting $2,000 a month. Like, we're going to give you a little bit of money to help you in retirement. This is only a temporary thing.
Sure.
And politicians said, no, we're going to make this a retirement full time.
Permanent.
So now we're $1 trillion a year.
Yep.
Just on that. And then you said the debt's $1 trillion a year and we don't make enough. So I think when you add all this stuff up,
it's rough.
I think we that's why I think people look at pensions and all this, and that's why we like the real estate game, and that's why a lot of these guys are saying, look, there's all this stuff, but you have a asset, you own it, you can touch it, you can feel it, you're in control of it. Your money's not in a pension where that's what people said is go ask about your pension, go ask what's in it, how much is in it.
Right.
When you ask the questions, you're going to be scared because
and
it's scary.
We said in moments of suffering, greatness is born. There's always opportunity.
That's what they're saying.
And even though markets, sure, we'll have adjustments. Right now, we're technically under a correction, right, until we hit 20%. And then it'll be considered a bear market. But we're correction right now. We'll see where it goes. I don't think it'll get over that 20%, but I may be wrong. Virus may come and kill us all tomorrow. Who knows? I don't know. I mean, who knows?
Yeah. No, I think looking out, it seems rates are going to be low for a while, which is good for lending. Then there's Alan Nevin, he's
the internal optimist.
Well, this is what everybody forgets is, over the next 25 years, the biggest wealth transformation is going to happen. So we see it on our side, especially commercial.
In what way?
So Grandpa dies.
Yeah.
I own 5 apartment buildings.
Gotcha.
And you and I are splitting. Great. We get $1 million each cash flow.
Because the baby boomers you're talking about. Yes, I would agree with that.
And then some of them, like Alan says, some of them are going to do good and some are going to sell and spend every damn penny of it. And
choices.
It's going to help.
Good choices, bad choices.
Yeah. And then you have technology, which is creating a lot of opportunity, I think things are every technology is looking at every industry. How can we change it? Whether it's good or bad, or it's fake or BS.
Yep.
We were talking about stuff off camera. There's the WeWork model.
Yep.
Which it's a good model, but when you get the wrong kind of money behind it, it's for the wrong reason, just pumping, it becomes a problem.
And a lot of technology is really going into the real estate space too, because I think residential's got a lot of great technology, but if you start looking at multifamily and things, you're starting to see some technology coming into our space, but not much.
So to touch on that real quick, I think it was the C conference. There's a big conference in Coronado every year where all the top CEOs from the major companies come for residential real estate.
Okay.
So last year, Redfin, Zillow, Compass, Sotheby's, all of them, right? They're all there. And at that time I was with Harcourts. The CEO of Harcourts went. And what they talked about there is, everybody doesn't really like Redfin or Zillow. But the CEOs got up on stage and they said, listen, this is what we're doing. They literally told everybody how they're going to try and screw everybody.
Point,
right.
Just
I remember
straight. Seeing that.
And they've said what they're trying to do is automate the offer process and automate the transactional process, right? And the minute they can do that, then the value of the buyer's agent will go first. So what will happen is all the downward pressure on the buy side fee of 2.5% is going to go to 1%. Mm-hmm. So the buyer's agent will find themselves out of the market pretty quickly. It'll be listing agents left. Mm-hmm. And then they're going to automate. So that's the offer process. Because if I don't need an agent anymore to go see a property anymore, right, and I don't need it really to offer anymore because I can just go online and make it through the offer process because they're bringing title companies, insurance companies, escrow companies into their ecosystem.
Yep.
So legally, they figured it all out. Financing, they figured it out. Title, all that stuff, they figured it out to automate that offer process. And then the transaction. So now we go from offer to transaction, escrow. And how do we automate that legally, financially, so it actually makes sense to alleviate all the parties involved or minimize the need for a full-blown, full-time listing agent or a full-time, full-blown buyer's agent. So therefore, we can take that 5 or 6% fee and squeeze it down out of the marketplace. So the buyer's agents will go first. Listing agents will still remain, but I think that fee is going to squeeze. Over the next 5, 6, 10 years, I think the next cycle is going to see that because they're getting ready. They're working on it. They have AI technology, all kinds of stuff.
And they're buying a lot of homes and
everything.
Rehabbing. They're losing money on it, but they can afford to. They're testing.
That's
testing.
right.
It's all testing.
They're trying to figure out ways to automate the offer and transaction process in real estate, residential real estate. And the minute they're getting good at it, and it's going to get better. So if I don't be a buyer's agent. So any agents watching, get out of being a buyer's agent. I always tell people, listing is as lures, right? List or don't last. Listings are lures. Buyer's agents will find themselves out of the marketplace, in my opinion, in the next 10 years.
Wow. That's wild.
Unfortunately, just by fees.
Yeah.
Because rather than seeing 2.5 on the MLS now, right, it'll go to 2. And then it's already seeing a little bit of that, and you'll see 1.5, right? Because they don't need you anymore. That's automated, right? So they don't need the buyer's agent. Now, some people would say, oh, well, we're in California. You need dual representation, right? You can't have dual agency. I totally agree with that. What happens, the listing brokerage is going to have an associate on the team that will represent the buyer. So you'll technically have dual agency, but it'll be at an arm's length, right? No different than 2 agents at Sotheby's or 2 agents at, Coldwell Banker or whatever. Same idea, but then it's on a team. It's not on a separate buyer's agent getting a separate 2.5%.
Right.
It'll be hey, that buyer's agent's getting 1%. The total fee's 3.5 versus 5 or 6. So
do you think if that happens, if you're you're an agent, you have a listing, and because of technology and marketing and the brand building, that you might be listing that buyers might just come right to you then?
It's happening now.
Yeah, why didn't the buyer just call you?
Yep, it's happening now. It's already starting to happen now.
Because they're technology, I can find the house.
That's right.
It just came up. I got the email. Call you. I want to put an offer. I know you're my agent. You're my agent. Let's go.
But then you have the buyers who want to feel like they have somebody representing them that does not represent the seller. So you got to deal with that aspect, and so that'll take some time to work that out. Before it's full-fledged, hey, I'm just going to listing agent. Because they still don't trust the listing agent. They're oh, you're
well, they're you're for the seller.
Yeah, you're not going to help me.
Yeah.
Even though legally we have a fiduciary duty, they don't care about that. So.
And it is tough going direct because it happens, there's certain brokerages in multifamily who really try to double end everything. And it becomes a problem. We're seeing because of rent control. I've literally had a couple appraisals come in low.
Oh, interesting.
Recently, which is bizarre. And so we've had a couple come in low, and we've had a couple situations where you have a broker who's representing both sides. So that becomes a little tricky, when your buyer's what should I do? I don't want to pay over appraised value. And your seller, they're this was a bad appraisal and blah, blah, blah.
Of course.
So you're dealing with all this. So it is a tough situation, and I get a buyer not wanting to have.
Yeah, so there's some nuances that have to be worked out with that. But the technology is going to help. Downward pressure on the fee, which you're starting to see that, which is, if you look at the last cycle crisis that had happened, all the 1%ers came into the market around the 11th hour. It's happening now.
Yep.
You notice it?
Yep.
Right? All the 1%ers are coming in, the home lights and the,
Yep.
not to help you sell, they're still here, but, you got all the guys doing the 1%ers, right? And you got listing fees of 1% by Redfin and so forth. So all that's pressure. Usually at the end of a cycle that starts to happen.
I remember it happening last cycle. Yeah, I remember. It's funny, Ryan Serhan.
I pay ones and help you sell and sell you states. And
Ryan Serhan was on stage and I saw a snippet and they said, "What do you think about this?" He says, "Yeah, we're probably in the market because soon as the market dips,
they're gone,
and you can't get a hold of that agent after 5 because they've got to go. It's over.
Right?
They're bankrupt. So
Correct.
he goes, that's the problem.
The niche is in the over $1 million price point. So the agents, in my opinion, that will last and really have a niche, because under $1 million, there's so much kind of automation in
data,
and easy to comp, easy to show, easy to
and you
market,
can streamline it too.
Bigger buyer pool, like all these things that are in that price point under $1 million in San Diego, right? At least the California market. Over $1 million, you need a little bit more expertise. Mm-hmm. You need people that know the markets, know the neighborhoods, know the nuances, know how to sell that kind of luxury property. That,
especially as you get higher and higher up,
right? And it gets right. Then the nuances really settle.
The buyers start going.
Correct, but think of it in the sense of, the travel agents in a way, right? So because of all the technology, in the lower price of travel, it became very automated. The travel agent went bye-bye. When someone needs a concierge and the higher end luxury services of travel, they go hire the travel agents who are still there. And they've been there for 20 years.
And they're doing good.
And they're doing great because they found the niche that, hey, the people who are willing to pay, who need a customized experience and will pay for that experience and level of service and knowledge and expertise, is in that kind of luxury game.
Yeah.
Or more luxury game.
Yeah, I think also too, like the investment property side, because I feel like that's like something
that's different. Yeah, because you need an expert in that arena.
Even like 2 to 4s. I say it all the time too. Is there are some apartment brokers that will take whatever 2 to 4s they get. Like somebody just said CoStar was just in my office earlier this weekend. They're like, California in general, San Diego specifically, is kind of over brokered. Like there's just so many brokers out there.
There's 25,000 realtors.
Yes.
In San Diego
so
at SDAR
many.
now.
Yeah.
It's a lot.
Yeah.
It's a lot.
So
well, you only have about 44,000 transactions in 2019.
So how many of those agents really know how to underwrite and analyze, a 2 to 4 unit investment property?
Not properly.
When I've seen online, like some of the stuff, I mean, we laugh because I'm like, there's no way that you're going to.
Like, that is not a cap rate.
Yeah, no.
that is not a gross rent multiplier.
Yeah.
You're so full of
Yeah, shit. Yeah.
I laugh at it. I'm like, so what? Doesn't work.
I tell people they come that they're buying 2 to 4, and I go, I would find a commercial where I'm like, because the person you're talking to is good at selling your primary residence,
right?
But they don't understand. They've never even owned or like you want to have a conversation with this is.
Yeah, and to give you an example, we sold a 4-unit in El Cajon that we bought a few years back, and we sold it last year. And I had literally prepped all of the because I understood how they were going to look at it.
Yeah.
Mm-hmm.
So I literally underwrote it for them. I handed it to their broker, and of course the broker, they question it. Is this like real numbers? But then when they actually got into the real numbers and got to see everything, they're like, this is like dead on. I said, well, yeah, because you're going to underwrite it to the like I would go underwrite a 10-unit or a 20-unit. Yeah. I'm underwriting a 4-unit. Even though you normally just base it on comps,
yeah,
I base it on revenue.
Mm-hmm.
So
that's cool.
Yeah,
I think it'll be interesting. I mean, new election year. It's kind of crazy. It's funny because it's like I know that, but it's like doesn't feel like an election year right now. It's like we haven't gotten into the.
Yeah, and we'll see what happens in the next couple of weeks. The whole Bernie thing. I mean, I'm not. I guess I would consider I'm not a Republican or Democrat. What's the middle line guy or the
a common sense person?
No. No, or you're socially more liberal, fiscally more conservative. What is that?
I know.
What's that? Libertarian. Excuse me. I think I couldn't come up with that. Libertarian. There you go. Yeah. So it's interesting to see all the stuff that's going on, and people say that America can't vote for a socialist. Under normal circumstances, that's true. But I'll tell you what, if Bernie believes every single thing he's saying, and he can sell it really, really well. And if you have an economic change,
Trump doesn't want it.
Well, if you have economic unrest and civil unrest, then that allows potential for socialism to be like, oh, like we want change.
This virus is not helping Trump right now.
Right. So it is interesting because I'd be like, there's no way Bernie can get elected. That's what they said about Trump until you get to a certain level where you're like, gosh, there's civil unrest and economic unrest. And if that grows and keeps growing to a point, America could actually be like, okay. I mean, not that we'll see. I hope not. Because, I mean, I'm more like, hey, let's just go moderate down the middle.
Right.
Like, just, down the middle.
Yeah. I mean, because honestly, some people, it sounds like good. Yeah, I just don't think people really.
They don't understand.
No.
They don't. But we already know how the book ends. There's plenty of other case studies around the world of socialism. It's very easy to be like, did that work? Nope. Did that work? Nope. Didn't work there. Nope. That didn't work there. But then they try and. And
it's you find out pretty quickly.
Yeah.
So
we'll see.
I don't know. It will be.
I'm neither here nor there because I'm pretty,
How's the market where you're kind of selling stuff? What do you just flat?
No, I'd say in general, I mean, the inventory's down.
Yep.
So things are moving pretty well. I mean, that's the challenge is lack of inventory or lack of good inventory.
Yep.
Because there's properties out there, but they're just
if a good one comes, it's like
they're either overpriced, right, not presented correctly, not marketed right. So that's why they're not selling. So, but the properties that are there that are meeting, the price, the presentation, the marketing are selling pretty quickly and moving off the market. So we're seeing things move. Interest rates are low. Things are going forward. Anything under $1 million realistically is gone pretty quick. It's when you get into the luxury price points that things tend to sit.
Where's
a
it
little more.
sitting? Three plus?
3.5
plus?
Yeah. You just have, in general, I think those folks are much more cautious right now looking at things. They're much more less to just jump onto a $5 million property or $3 million property. So they're being much more careful. And
with La Jolla, I was going to ask you real quick, the people, are you seeing a lot of people move here from out of state, or what kind of buyers you get, just local? Or
No, heck no. We see it coming out of, believe it or not, Texas. I mean, even though people are saying Californians are going to Texas, but we do see people coming out there.
Texans want to be in California,
right.
too.
Why is that? Why is anything?
I don't know.
Weather just.
That's a good question. I don't know.
Want to be by the beach.
Right.
Everybody
loves the ocean.
I think they made it.
I always say if
you
have the money, you want to live here.
You do.
Yeah,
you
for
do.
sure. Come on.
You absolutely do. But I'd say you get Canadians, Arizona. We always know the Zonies come out. That's pretty common. And then you get people from Nevada. The Zonies. The Zonies. We call them Zonies. It starts.
People from Mexico too buying a lot.
Yes, but they'll come into Coronado a lot. A lot of
especially with the presidency going on, people are like
Mexican families. They'll come into Coronado big time. The Cays, they love that areas, and they want secure communities.
Yeah.
Even South Bay, they'll go into Otay Mesa, but some of the secure gated communities because they come from an environment of it's not secure, so they want their family secure, and then they go work back in Mexico and come back and forth.
Yeah,
happens a lot.
Yeah, I think Otay was really like a blessing for people from Mexico too.
Big time.
It was like,
nice communities, newer
beautiful.
Construction. There's some beautiful estates back in there.
And that toll road's like really helpful now that they built for people traveling. We went down there. I took Kenny down there one day just for shopping for something, and he couldn't even believe it. It was like, wow, this is like it's like a brand new city. Everything's gorgeous and new, and
right. So we'll see.
And they've got expensive communities there now too.
Big time.
They've got like
$1, $2+ $1 million homes.
Yeah.
Yep.
Yeah, because I feel like this cycle, even though we had a rise, it was good. It's not as crazy as last cycle as far as like.
Well, because they're not giving out free money anymore. I mean, you guys know you're in the lending industry. I mean, they're offsetting maybe stated income loans with more equity in, right? So they're making people some way, shape, or form have some skin in the game, or they're underwriting you and actually what you make. Versus before, as we all know, stated income, negative amortization, 100% finance, walk in. Oh, you make 80? No, you make 160 today. Here's going on your app. And
even for us, with apartments, we used to have, I remember these loans that we based on break even. Like you can't do like a one-to-one debt service anymore. It's like there's no such thing.
Yeah, now they're at least.
But I feel like people are like trading up too. There's this whole phrase like sell our house and get a bigger one. Like it's like I just don't. I mean, I'm sure it's there, but I'm not seeing.
That's part of the challenge with the inventory.
They're not selling.
Is people would like to sell, but where are they going to go? I mean, unless they're moving or downsizing and there's a life event happening.
So they're rehabbing, staying and rehabbing.
Right. They're staying in the homes longer. Where normal turn time was about 5.5, 6 years on a house turning. Now it's up to 10.
Holy shit, that's double.
So that's why you're seeing, it's a combination of multiple things, but that's one of the reasons you're not seeing as much inventory come on the market is people are staying in their homes longer because they want to stay. They just don't know where to go and they can't afford to move up, right? And they don't want to move down yet. So the only people that really are moving is due to a life event, right? They have more babies, or they need to downsize, or they need to upsize, or they, whatever they're doing. It's a life event that's usually making that happen.
Yeah, it's more of a need, not a want.
Right.
Yeah.
Right.
That makes sense.
Well, this is a fun little chat. No, it was because I mean, it's you don't.
Sorry, we got off on a little politics for a second. Don't want to do that.
I know we had.
That doesn't usually happen too, by the way.
Really?
We just
I try
But
and
not
pull
many
it.
agent. You're not gonna have many real estate agents coming here and talk about multifamily. So that's
Really?
fine.
Oh, that's good.
we're like, for me, I've always thought, if you're in real estate at all, why are you not drinking your own Kool-Aid? Like, why are there so many brokers and real estate agents and lenders that own nothing?
Yeah.
They own a home,
Yeah.
and somehow
Even commercial
yeah.
brokers.
Well, and even the traditional viewpoint of the single family home being the American dream of wealth creation. It can be a great wealth creator. There's no doubt about that. I'm all in for the home ownership side of it, but you've got to own diversified portfolios, right? You got your 401k, and maybe you got a life insurance policy over here that has a wealth value to it, and then you got to have some ownership in some properties.
Well, I mean, for us,
Something,
I
yeah.
think one of like our guy who helps us with some marketing, he always says like the thing that I find so unbelievable about you guys, me and my wife, is that you guys don't own a home. And it's like, for us, we were like, we need to invest and
Yep.
have assets that pay us first to get to, like you said, we have
Sure.
a goal, you get to a certain level, and then you're like, I'll buy the house because guess what? Now I have assets that pay for this house.
That's right.
And so
That's hard.
even though I want to own a home and I want to have one that's my own and it can be a good wealth creator,
Sure.
the multifamily is better. So we got to go for that first.
Yep.
So that way we're not grinding every day just to pay your mortgage.
Yep.
Let your tenants pay your mortgage.
Well, it depends. Which quadrant are you in?
Right.
Right. If you're in the E quadrant where you have that W-2 and that's a safe environment for you to be in, then it's fine. But just know that if you're in the E quadrant, the reality of you retiring at an early age is not likely.
Right.
You're going to have to do the whole 65 or 70 thing.
Right.
Hopefully accumulate enough wealth by that time to
Right.
then finally retire and then have quote unquote free time. But if you're trying to accelerate that ability to have the free time earlier in your life, you have to get into the B or you have to get into the I or both. That's the only way. Once I understood that from Robert Kiyosaki, I was like, so that's the only way it happens, like sooner in life?
No other way.
He's like, yeah, it's the only way it happens sooner in life. Is you have to be in one of these two quadrants. Otherwise, you're going to be in the E or the S until you're dead.
And that was the big thing too that they were talking about on that podcast about the pensions, is also the average amount of money that people have in their 401k is insanely low. It's like $62,000 on average. So it's like some of these people are going to be working until they die, basically, because
Yeah, is that because of the tank and they haven't gotten back, or is that
I
because
just think a lot of people
they're not
just-
saving? You're saying, gotcha. Yeah, well,
people
because
don't.
costs of expenses are so high,
Yeah.
they can only put in so much.
they need
And
that
also,
money.
we live in a world where you're a click away from a TV, a phone. I mean, whatever you want.
Sure.
Right? It's easy to get stuff.
What does Gary Vee say? Stop buying stupid shit.
Yes.
Stop buying stupid shit you don't need to
You don't
impress
need-
people that don't care about
I
you.
don't
or
care
something.
about it.
Yeah.
It's-
Yeah.
I don't know if you watch that guy a lot.
I went to his 4D. I went to his
that guy
yeah.
cracks me up, man.
It's kind of what
Impersonates.
started Kenny on the social media kick. I found him, and I started listening to podcasts. Kenny was not a technology guy whatsoever,
Right.
and I'm like, Kenny, you gotta listen to this guy. He's kind of a lunatic like you. Like you gotta listen to him. So
He's a straight
that got
shooter.
him.
I
Yeah.
mean, you want no BS. That's
Oh, no.
clearly
you
no
want
BS.
in your face.
Yeah.
Like
He's your
the
man.
guy. And I think he's kind of the first person you start with if you're not listening to social media or anything. You kind of start at Gary Vee.
Yep.
Because like we were even saying, just with social media, his big push is just do it. Like
Yep.
just do it. Like just give everything away and just do it. And that's very true.
And
But
refreshing,
then-
too.
It is, yeah. And so you just do it, but then after that, you do it for a while, and you're like, okay, now I need a strategy. You know, I just
And that's
did
what
it.
we're on to now.
I threw it
that's
out
where we're
there.
at. So we do. I mean, our business and the investments, but we're putting a lot of time into building the brand and doing that. So
Yeah.
that's kind of like the next phase of it all. But
Well, you cultivate your subscriber base and your following.
Yeah.
Right. And then you have to find a way at some point to monetize that.
Right.
So it's just quick. At what stage does that start to happen?
Yeah.
But you have to grow it. It's like giving away a free app, right? You give the free app, you give the trial. At some point, you're going to have the user database where you're like, okay, we have to monetize this now
Right.
and move to the next stage. Yeah.
Right. Yeah.
So-
And the podcast has been fun. Like we've
Yeah.
had a lot of fun doing
Keep
this.
doing it. I
Yeah.
hope you guys keep doing it.
Yeah. Well, it's
No,
funny
we
because a
will.
lot of people will ask us. We've had a lot of people come in here and go like, well, but do you get business from it? Yeah. Well, how do you track that? No, you don't track it.
You
It's-
don't. Yeah, it's really
you
tough
don't.
probably on the ROI side to say like, yeah, we get this, but
But if you love it and it's
Who
helping get the
cares?
word out there,
Yeah, and
great,
it's just like, it's like Gary said, or anybody now, I get it. It's like people have heard enough of us on this or in content. They know who you are.
Yep.
So if they want to work with you, like I want to work with somebody like that, they know what you do, who you are, so they can find you easy. In your competition, like you're an agent, they do this. But if you're an agent that doesn't have anything, they're going to go, well, this guy has 20 videos about who he is. I feel you have nothing. I'm just going to go with him because I feel this. That's what Gary said. I feel this
Like, I
connection.
know
And people do business with people they like and trust.
Yes.
It's very simple, especially in the service industry.
Yes.
It's, do I like you? Do I trust you? Great. Okay, let's do some
Especially
business.
selling your multi-million-dollar house
Right.
for a good, it's like, you know what the hell you're doing. Yeah.
That's right. Yeah, it's a big ticket on all that stuff. So,
So where can everybody find you?
Google. Just Google Justin Brennan. I hope I pop up everywhere. We do videos. We got,
you do. I checked.
So
You pop right up.
all right.
Yeah, there you go.
We won on that
They're
one.
like a key search term
Are we
already.
really? Like I come in the
Like
the
if you
automatic.
if you start typing Justin,
It
like
does Justin Bieber, doesn't it? Don't lie.
Well, he's definitely
he's not beating the
he's
beats yet.
definitely one or two ahead of you, but
I'll give him that.
Yeah.
I'll give him that. I really liked it when I was right underneath Justin Timberlake. I was like, now I'm
Oh,
really
yeah,
making it.
That's awesome. But yeah, they can find you there. And thanks for coming on. This is a fun chat.
Appreciate it. This was a lot of fun. Kind of getting to know you guys and what you guys are doing, and
Well, we always think we know everybody in San Diego. It feels that way after a while, and then there's like people that have kind of come into the business over there. You get to know like all the kind of good old boys who've been around for 30 years.
Sure.
And then it's nice to start to get to know other people who are more in our age group doing similar things.
Yeah, and somebody asked me the other day. They said, "What's your?" And I said, "My goal is not to be the number one realtor."
Yeah.
I said, if I wanted to be the number one, I could just, because
All
I know Seth O'Byrne, I know them all. I mean, we're all there, but it's like, do you want it? I know how much time and energy that takes, and if I do that 100%, there's no way I can do the apartment stuff.
So you literally
And
have
if my
the
exit
same
strategy is here, then I'm going to give really good attention here because that's important. But you gotta,
We're literally
Yeah.
have the same conversation.
We have that
It's
conversation
like,
all the time.
and I realize that people is when they're all in and they're just, all in and crushing it, they literally don't have any time for this. And I get it. But hopefully.
and then they stay in the S quadrant.
They do.
And it's hard to get out of that S quadrant
Yep.
once you get going and the money's there and all
And
the things are there.
If you build, get a nice house and lifestyle that you keep
Now
feeding.
the lifestyle went up here, and you got to feed the machine.
Yep.
So
And then they got to stay at number one.
yeah,
So unless they like strike it big or win the lotto.
Honestly, though, a lot of those people, like Kenny has said, even like if he wanted to be a top LO, it's like they have these big teams and everything, but you're like this, you're handcuffed to your business. You don't have time to take a minute to breathe, to think about it.
well, and find out what your passion is.
Yeah.
At the end of the day, follow the passion. The money will find it.
Yeah.
It will. You got to go.
I think we kind of share the similar passion.
Thank you guys for
Thanks
having
for
me.
coming
Thank you.
A lot of fun.
Yes. All right.